Hey, good morning, options traders, and happy hump day. And I thought it would be helpful for our new traders to talk about a better way to set stop orders. I hear so many traders talk about setting stops and the importance of stops, and that's a whole separate argument, whether it's even a good idea. But for those who do use stops, whether it's on an option or on shares of stock, I find that most people go about it the wrong way. They set it up in a way that they are virtually guaranteed to get stopped out and therefore virtually guaranteed to end up with losses. So if you are using shares of stock, and there can certainly be arguments for that, even if you're an options trader, such as during periods of high implied volatility, you might be wanting to set a stop order. So what's a better way to go about setting your stops? Well, for a quick review, what are stop orders? Now, I do have another video in here talking in detail about the difference between stop and stop limits and how they work. But just for a quick review, just only on stops, here's the way they work. Let's say that the stock is trading for 100. And so you've got shares of stock in your account, again, trading for 100. And you say, well, I don't want to set a stop in case this stock price falls. So the computer will automatically sell them for me. And you place an order to sell your stock at a stop of 95. And what this means is that if the stock trades at or below 95, or whatever number you pick, that's called your stop price. What's going to happen is that the computer submits a market order, and therefore it's absolutely 100% guaranteed to get sold. Now, what's not guaranteed is that you're going to receive that stop price. That's another misconception that a lot of new traders have. They say, well, I put a stop at 95, and therefore I'm guaranteed to get 95. Not true. Look at the definition. If the stock trades at or below 95, it's going to submit a market order. So what could happen is the stock might close at 96 one day, still didn't trigger your order, but then the next day it gaps down to 70. Trigger the order, you're going to get filled at 70. So again, those are different issues, whether you should even be using stops at all or the risks involved. But again, if you are using them, you just have to understand that the stop price that you pick is just a trigger point. I sometimes call it the line in the sand. You're saying to that stock price, if you cross this price, in this case 95 or lower, the computer's going to submit a market order. Okay, so those are the basics of how the stop works. How do we go about setting a stop price? Or at least how do most traders do it? They go about it the wrong way. What happens is that traders set stops close to the current stock price. Why? Because people are risk averse. They don't like losing money, and they say, oh, I just can't bear the thought of losing it. So if the stock is trading at 100, let me put that stop really, really close. And they think they're doing themselves a big favor, so that if they always manage to take small losses, that somehow they'll be ahead of the game, because every once in a while they'll just hit these huge home runs. The problem is you are virtually going to get stopped out every single time. So here's the way that they would typically go about it. Let's say that our stock is trading for 100, and they say, well, let me just buy 200 shares, and that's 20,000 bucks. They just pick some arbitrary amount of money, or the amount of money that they're willing to put into it. But then they say, all right, now I'm only willing to lose, let's say 500 bucks. This willing to lose amount is always very small. And so what they'll do is they'll say, well, if I've got 200 shares, and I'm only willing to lose 500, I should set my stop at 97.50. And so that way I would lose $2.50, right? If I paid $100 for the stock and I sell it at 97.50, I lose $2.50 times 200 shares, or there's my 500 bucks. Now, once again, this is assuming that the stock didn't blow straight through our stop price of 97.50 and is trading at 70. But at least conceptually speaking, this would be a way of thinking that we're going to limit our loss to about 500 bucks. So notice that the stop is about 2.5% below the current stock price. Well, that's nothing. Stocks can drift up or down 2.5% on no news. That's not all that uncommon. So again, what's going to happen is that for no other reason than just noise in the markets, you're going to get stopped out. And that's not a good way to approach it. See, what you're doing here is you're letting the amount that you're willing to lose dictate where that stop price is. And so what you need to do, a better way, is to have what some traders call a conviction price. at what stock price is going to convince you that your outlook is wrong. All right, so we bought this stock obviously because we're bullish, but what stock price will convince you that the outlook is wrong? So let's say that the stock falls from 100 to 90, or it's down 10%. And you're saying, okay, if that happens, then I'm wrong. For whatever reason, I thought it was going higher and it just isn't. But notice this is different from if I had asked you and you probably wouldn't have said 97.50. And yet that was the stop price that you just put on the previous screen. See, if we change it to saying what stock price will convince you that your outlook is wrong, now we're working the problem backwards. So now we know that a 10% drop down to 90 will convince you, whether that's right or wrong, that's your point where you're going to say, I'm wrong. Now let's say, how much are you willing to lose? Let's use the same number of 500. So what you do is you take this number that you're willing to lose divided by that percentage drop. So 10% as a decimal is 0.10. So 500 divided by 0.10 is $5,000 worth of stock. And because the stock is trading for $100 per share, you could buy 50 shares. So again, we're just working it backwards and saying how many shares should I buy so that my outlook or my conviction price will in fact equate to the amount that I'm willing to lose. So see, now if the stock falls from 100 to 90, we've lost 10 bucks on 50 shares, and there's your $500. But see, those are two very different prices. 97.50 is far more likely to get hit than 90. So this is a much better way to approach your stops. So the basic idea here is to remember to work backwards. Start by asking what stock price will convince you the outlook is wrong, and then figure out what is that percent change. How much is that stock price down in terms of a percent? Then take the dollars that you're willing to lose divided by that percentage change. So again, in the previous example, we said if the stock falls from 100 to 90, I'm convinced that I'm wrong. So 90 is my conviction price. That was down 10%. That's my first step. And then I'm going to take the dollars that I'm willing to lose, 500 divided by 0.10 is $5,000 worth of stock. So again, do you see how it's working? We're working the problem backwards and saying how many shares of stock should I own rather than saying what stop price should I use on an arbitrary amount of stock so that I can limit my loss. Because when you do that, you're going to have very, very tight stops. So here we would also say that if it's trading for 100 bucks per share, 5,000 divided by 100 is 50 shares. So it's just a matter of working this whole process backwards. But I think the most important point is that you start with your conviction price. What price will convince you that your outlook is wrong, and then just work backwards from there. Because if you do it the other way and you just buy an arbitrary amount of stock, and then you say, I'm only willing to lose X amount of dollars, your stop price is going to be very close to that current stock price, and you are almost virtually guaranteed to get stopped out at a loss. Now this is where the options can really shine, because if, in this example, if we had a $90 call and the stock price dips down below there, we don't get triggered out. We still manage to control those shares. We just have the right to walk away. But that's, again, a separate story for a separate video. But for right now, I just wanted to talk about, for those of you who do buy shares, and there are certainly times that that can be the best choice. But if you're going to set your stops, make sure that you're going about it in a way that is going to be more conducive to your outlooks, that you're not setting it at a point where you're virtually guaranteed to take a loss. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.